Hello everyone, welcome to the channel. Either you clicked this video by accident or you want to learn about buying call options. And congratulations! Somehow, out of the hundreds of videos on this subject, you have chosen the worst one. Regardless, by the end of this video, you'll have the knowledge to aid you on your journey to become a more powerful investor and hopefully make more money than me. But remember, option trading can be very dangerous and you could end up losing all your money. Thanks, Crocodile Dundee. And he's right. Option trading can be very dangerous, so make sure you do your research beyond what this video offers. Options are financial instruments. No, not those instruments, Ghost of Louis Armstrong. Financial instruments, known as derivatives. No, not those derivatives, Ghost of Sir Isaac Newton. They're called this because their value is derived from the value of an underlying asset, typically a stock. If you have no idea what that means, it's okay, because I have no idea either. Just remember that options and derivatives are the same thing. An option is a contract that gives the holder the right, but not the obligation, to buy or sell the underlying asset at a predetermined price before or at the expiration date. In other words, an option gives the buyer of the option to execute the buying or selling of an asset at a set price. There are two main types of options: call options and put options. A call option gives the holder the right to buy an asset at a specified price within a specified time period. Buyers of call options anticipate that the price of an underlying asset will rise. You can remember call options are associated with rising prices by thinking about how when the money in your bank account rises, everyone in your family starts calling you. Hey Grandma, what's up? Oh, nothing, sweetie. I just wanted to check up on you and get some money. Oh, thanks, Grandma. A put option gives the holder the right to sell an asset at a specified price within the specified time period. Buyers of put options anticipate that the price of the underlying asset will fall. You can remember put options are associated with falling prices because when the money in your bank account goes down, everyone puts down the phone. Hey, Grandma. Sorry I called. Times have just been really tough lately. I lost my job, my wife, my kids. I just really need some help right now. Grandma? Now, to summarize and simplify everything that has been stated so far, options are a contract between the seller of the option writer, and the buyer of the option holder. With the purchase, the option holder now has the right to buy or sell assets from and to the options writer. It is important to remember that an option is not the asset itself, but a contract that gives the buyer of the option the right to trade assets with the option seller. There is also some additional important information. The predetermined price of an option is called the strike price. Options have an expiration date. An option contract is responsible for 100 shares of a company, and the price to pay for an option is called a premium, which is paid on each share the option controls. For example, one option contract that is listed for 60 cents will cost 60 cents times 100 times one option contract, which will equal $60. Or if you buy 5 contracts at 50 cents, that will cost 50 cents times 100 times 5 option contracts, which will cost $250. Reminder that these are the prices that it costs to pay for the option contracts, not the assets. Now, it's time to talk about buying call options. Let's break this down a little to the fundamentals using a real life example that I made up. Imagine you're the buyer of a call option for chicken leg automotive stock, which at the current market price is, let's just say $24.56 per share. For simplicity's sake, we'll round it up to 25. Now, you buy a call option for chicken leg automotive with the strike price of $30, expiring in 30 days, and the premium is 80 cents per share. This means you have the option to buy 100 shares of Chicken Leg Automotive at $30 within the next 30 days, But you also have to remember that buying the single call option itself costs 80 cents times 100 times one option contract, which is equal to $80. Now let's talk about the ways you can make money buying call options. If Chicken Leg Automotive stock price rises to $35 within the next 30 days, you can exercise your option to buy Chicken Leg Automotive at $30, which just means buying 100 shares of Chicken Leg Automotive at $30 and immediately sell those shares at a market price of $35. For your profits, you buy at 30, sell at 35, that's $5 per share. Oh, but wait, you also have to remember the premium cost of the option, which is 80 cents. Now, your net profit is $4.20 per share. And since each options contract covers 100 shares, your total profit is $4.20 times 100 times one options contract, which is equal to $420 in profit. Nice. You can also make money from your options contract by selling the option at a higher premium than you paid. Now, here are all the scenarios where you can lose money from your options contract. You know what they say, no pain, no gain. And with options, there's a lot of pain. Let's look at an instance where the stock price falls. If Chicken Leg, I'm just going to call it CLA now. If CLA drops to $20, your option is worthless because you can buy the stock cheaper on the open market since $20 is less than $30. That means you wasted all your money buying the option. Now, the second instance is when the stock price stays the same. If CLA stays at $25, buying at $30 makes no sense for the same reason. 25 is less than 30, making the option worthless. And that's right, you wasted all your money buying the option. This next scenario is when the stock price rises slightly. If CLA rises to $29, it is still not beneficial to exercise the option at $30 because $29 is less than 30. Now say it with me, you wasted all your money buying the option. So now hopefully you understand that in order to make profit over the execution of a call option contract, the stock price has to be above the strike price of the option contract. But you also need to know how much higher the stock price needs to be. That's because you still have to consider the premium you paid to buy the contract in the first place. In order to find the break-even price of executing the contract, you simply add the strike price of the options contract to the premium per share. So in this case, $30 strike price plus an 80-cent premium means that in order to make any profit off of executing the options contract, Chicken Leg Automotive stock needs to be above $30.80 per share. In the end, the largest risk you have with buying call options is the premium you paid for the contract. Well, now we've reached the end of this video. There's still a lot that needs to be said about options, and I haven't even covered everything with call options, so stay tuned. I hope now you understand a little bit more about options trading and are starting to become more comfortable with stepping into the world of losing all your money. Just kidding. Just join r/Wall Street Bets.